We have Mayuresh Joshi to talk about the fundamentals of the markets right now, and we have Rajesh Palvia joining in from the studio. Thank you so much, gentlemen. Welcome to the show. Quickly, as we have Rajesh on the show with us. Rajesh, I remember last time you came, that day also, dear, we broke 200 DMA. This is the second time. So Rajesh, he understands the pulse that whenever there is that a stronger view is required, he's been kind enough to come to our show. Rajesh, now what do we make of this? We've not got any support at 23,500.
So this is the third time where we are, slipped below to 200-day moving average in last 2 months. So that clearly shows that, confidence is very low in market, and FI supply pressure is very high at this juncture. So I think these kind of supply pressure keeps on continuing in this market. I think we will not be able to sustain about 200-day moving average. This is the 5th consecutive day where we are trading below to 200-day moving average for both the indices, Nifty as well as for the Bank Nifty. And Bank Nifty has shown very deeper cut, like 4.5% during this week. So the kind of supply pressure in the banking and financial is clearly showing that still market is not trying to find any kind of bottom at this juncture. We are almost trading near to crucial support area of 23,300, which is the previous swing low. And if we look at the rally, which entire rally after the general election in June 2024, we are now almost there at that level only. So rally started from 23,300 and we have moved to 26,000. Now again we are back to the same level. I think if we breaks below 23,300, that would be very negative for the market at this juncture, and then maybe possibly we may slip below to 23,000 level also in the continuation of this down move. So I think those who are still holding long and they're not able to exit from the market, they should follow 23,300 as a stop loss. Those who are trader in nature, if it's break, then possible cut can extend to 23,000 and 22,800 on the downside. On the higher side, 23,750 is the key area. Until unless Nifty not crosses those level, there won't be any confidence on the any kind of minor pullback. So 23,750 needs to cross on a weekly closing basis. Then only we may see some again interest on the buying side. But again, this is very eventful month, so I think uncertainty is still there. So market is likely to behave on the bearish side in the coming week also.
Rajesh, 23,750, that seems to be quite the tall ask that we are asking from the markets right now, given the way they're going. Mayuresh, hi, thanks for joining us on the show. Give us a sense of what kind of momentum you are expecting when it comes to the markets next week, because we've had numbers coming in from TCS, good set of numbers. IT is looking good. Next week we get a little bit deeper into the Q3 earnings. Tell us which sectors you think are going to emerge as winners, or if you could put it that way, the one with the least amount of cuts coming in when it comes to the earnings preview for Q3.
Very good afternoon to you. So two things, I think, as we see our earnings forecast chart put through Pandre, our institutional software, and the sector rotation graph that we probably have, which takes into account earnings that have happened till the quarter gone by and expectations of consensus earnings over the next few quarters. BFS as a space selective probably looks the strongest as far as the EPS ratings are concerned. Obviously, I think the backing for such strong ratings is by strong numbers that have got exhibited in Q2 and expectations in terms of some areas of this segment still continuing to do well compared to the broader markets. The second element is also utilities is what is showing up in terms of the EPS ratings and strength. Within utilities, you can very well define a few infra companies, a few cement companies, a few power companies. But as a theme, I think power should continue doing well. Obviously, what you've probably seen in terms of infra and manufacturing over the first half of the last financial year or the year that is ongoing at this juncture, state elections, monsoons, general elections, all have hampered order flows. And therefore, expectations of order flows coming back probably seem to be on the card. Agrochemicals, specifically as a space, also probably looks well positioned, specifically the domestic players, because both the EPS and RS ratings probably look very, very well positioned. The strong set and the expectations of a good Rabi season might mean that Q3 and Q4 might continue to do well for these companies, along with backward integration that they're coming in terms of capacity expansions and deleveraging on their balance sheets. Last but not the least, I think IT as a space with a becomes a perfect hedge of sorts in terms of expectations of stable earnings going forward. TCS has led the way so far. If other companies probably lay a similar path in terms of commentaries and growth prospects going forward. This is one sector that might continue doing well, very, very strong EPS and RS ratings. And pharma selectively should continue doing well. So I think you've got these couple of defensive sectors expected to do well. BFSI, agrochemicals, and selectively between infra and manufacturing.
Okay, Mayuresh, thanks so much for being on the show today. Just a follow-up to what you just mentioned, that IT, agro, BFSI to some extent. Now, just to draw a comparison, what we saw in the last quarter, the more misses than hits what we saw in the last quarter. And the major of the drag was coming in from commodities, unsecured lending, and even the consumption. Is that pattern going to repeat? Is there any green shoots, or is this going to be like a Xerox of what we saw, or maybe similar to what we saw in last quarter's earnings?
Afternoon, Priyanka, to you as well. No, I think a large part of the market is going to remain soft. There is no two ways about it. Not just seen initial signs of how consumption is slowing down in Q2, but it's becoming very, very evident as we are heading into Q3 as well. Right? Doubt this is structural in nature because certain pockets of the entire consumption spectrum are still doing well. So I think some higher priced items, whether it's luxury items, watches, whether you're talking about high priced cars, higher priced real estate inventory, still expected to do well. Having said that, I think the expectations in terms of how commodities might play out, and again, if you probably look at hard commodities, which is metals, both ferrous and non-ferrous, still expected to be soft. Even if you see some element of volume despite happening, the LME pricing is not supportive at all. And because of that, I think the entire operating leverage might not get played out. Obviously, you've seen HRC, CRC prices head lower, and you've seen a lot of volatility as far as input costs are concerned as well. So commodities as a space, obviously a little bit more careful at this juncture. For soft commodities, again, I think you have to play the cycle very well, whether you're playing tea, you're playing coffee, whether you're playing sugar, which has again become a pure play ethanol story going forward. For soft commodities as well, I think there are a lot of global cues that one needs to attack for. And therefore, I think the entire basket, one needs to be very, very stock specific. I think we just can't paint a single brush for that. But largely, I think earnings for the commodities space should remain soft. Earnings for consumption as a basket largely should remain soft. Durables might do a tad bit better within the consumption basket compared to discussion.
So that view coming in. Rajesh, coming back to you once again. This entire week, we've seen a rather mixed bag of updates coming in from PSU banks. Some have been good, some have been rather decent or mixed. And that sector has been your biggest losing sector. It's at a 9-month low right now. Going ahead, are you seeing some scope of reversal on the charts for PSU banks, or do you think it's private banks that are going to be leading the way? Because even Nifty private banks has not done all that well, but at least a little bit better than PSU banks. So what's the outlook, and if you have to play the entire banking and financial space, would it be PSUs, private banks, or NBFCs would be your topic?
So I think if I have to choose from banks, though, I think yes, my choice would be on the private bank only. Even in the recovery also, PSU banks was not able to recover as much as the private bank have recovered in the previous rally. So I think if at all any pullback comes in banking space, the private bank will outperform as most of the PSU bank have broken their important support area on their long-term chart. So I think recovery will be slow in PSU bank compared to the private bank. So I think in private bank, I think ICICI Bank and this HDFC Bank can be looked at in this correction, and these two banks can again recover once the market stabilize at certain level. Only in PSU bank, I think we are focusing more on the SBI. That's the only stock where we like based on the technical parameter on the long-term chart. So that stock can be looked at from the PSU basket, but our focus more on the private sector bank at this juncture. But yes, in NBFC, some of the pockets are looking very attractive, and I think some recovery we have already seen in some of the NBFC space. So stock like Bajaj Finance, Bajaj Finserv, Chola Finance. These all stocks have shown some bit of recovery in last couple of week. But again, looking at the market condition, these all stocks are also witnessing the supply pressure. But maybe we may see some recovery in NBFC pockets. Bajaj Finserv, Bajaj Finance, Chola Finance. All these stocks are on our buy list. So once market start recovering, we will focus on these stocks to buy.
Okay. In fact, yes, to your list, stocks like even microfinance institution like Spandana, Spurti, and all these were also buzzing in trade. Maybe there was a technical rebound which looked likely possible. We stay for a short break here. When we come back, we speak to both of Mayuresh as well as Rajesh. Stays with us. Don't go anywhere. Welcome back. You're watching the weekly edition of Your Trades on ET Now. I have Snehi with me, and of course our two special guests today. We have Rajesh Palvia and Mayuresh Joshi with us. Rajesh, quickly tell us, since we understand you've spoken about that, we are still in a wait and watch mode. There are no clear direction that where market is going to take a tide. Now, in this scenario, would you want to stay with the outperforming sector? What would be your top recommendations for our viewers?
Yeah, definitely. So one should remain on the top performing sector only, and the only sector where we are focusing at this juncture, that is IT, is the sector where we may see bullishness to continue, and some of the sector like pharma, chemical space is also showing some bit of buying interest, and FMCG. These all 3-4 sectors are looking attractive at this juncture despite of this kind of sell-off which we are seeing in the market. So top pick would be from the these sectors only. So one long call on the pharma space, FMCG space, that is Marico. Stock is showing breakout on the near term chart, and looking at the structure for Marico, we believe that here there would be continuity of uptrend 695 where we are projecting target. Keep stop loss of around 658 to buy Marico. Another stock, that is Uno Minda Auto Ancillary stock. Stock managed to give breakout on weekly chart of its falling trend line, and the way stock has witnessed the buying action throughout the week, we believe that here there would be continuity of uptrend. Possible target towards 1150 we may see in the coming week with stop loss of 1070. One short idea that is on cement sector. We have seen most of the cement stocks have witnessed a supply pressure throughout the week. Ultratech is looking bearish. Stock managed to give breakout of all its important moving averages. So one can go short in Ultratech cement future for downside target of 10,600 with stop loss of 11,200.
Okay, so those are two picks on the long side and one on the short. Ultratech cement, slightly cautious view coming in from Rajesh. Mayuresh, coming to you, let's talk a little bit about the AMFI numbers that we've seen. Mid schemes are the ones that continue to see a good amount of inflows coming in for the fifth straight month. It's been an inflow coming in for these schemes. Going ahead, over the course of the week, or rather we've seen the biggest cuts coming in from the broader markets. It's been a week of the large caps. Going ahead, as Rajesh is pointing out, the market could continue to remain shaky. Do you think the large caps would be a safer bet, or now do you think it's time for the broader markets to pick up once again? And what's it looking like on an overall market breadth basis?
It all depends on how numbers play out for the broader markets, honestly. And therefore, I think larger markets might outperform the broader markets, at least for this quarter. Within broader markets, again, I think, as I said, within the spaces that I discussed, you need to be very, very stock specific here. Only go for stocks that have leadership position and where earnings look a little bit more stable in this volatile environment. So being very, very selective on broader markets, large caps might out.
Absolutely. Thanks very much, Mayuresh and Rajesh, for your view and insights on the markets at this point in time. We'll have to really...
If you like this video, then like, share and subscribe to ET Now.